Howdy everybody, welcome back to Intermediate Accounting. I hope you're having a great day. We have a really fun topic for our video today. We're going to be talking about an item that you see quite a bit if you're looking at the financial statements of a publicly traded company and you're reading through that balance sheet. If you follow business news, you're reading Wall Street Journal, you're watching CNBC, chances are you're going to hear about the topic that we're going to be talking about today, and that's Treasury stock. Treasury stock is simply when a company buys back their own stock. Now, there are all kinds of reasons and motivations why a company might do that. We're going to get into those in the video, and we're also going to talk about the accounting for Treasury stock. And just to kind of start off with an example here like we like to do, we're going to look at Bed Bath & Beyond. If you've been in a Bed Bath & Beyond lately, you've probably noticed a store on the decline. Lots of empty shelves, not a lot of customers milling about. Just a business really struggling right now. In fact, recording the video right now in February of 2023, last month, Bed Bath & Beyond came out and said that they were basically on the edge of bankruptcy and they were getting ready to file, and meaning they are about out of money. So let's take a look at their financial statements here. Bed Bath & Beyond, man, look at that income statement. One of the narratives around the pandemic as far as business was concerned, was all these companies that dealt with like home furnishings and home improvement were going to do really well because people were spending a lot of time locked down due to the government regulations on the pandemic and the mandates and things like that. And it was kind of predicted that people would improve their homes because they were spending so much more time at home. Bed Bath & Beyond was not able to cash in on that phenomenon. If you look at 2020 to 2022, man, revenue had dropped from $11.1 billion to $7.8 billion. And their profitability was negative. They had a net loss every single year from 2020 to 2022. Now, you don't have to be a business savant, a business genius to understand that if your company loses money year after year, you're probably going to run short on cash at some point. So let's take a look at the balance sheet here. Bed Bath & Beyond. You see the losses right there? Oh man. Cash and cash equivalents on the balance sheet from 2021 to 2022. They burned through $1 billion and they are about out of money. As you can see, their current assets here basically at this point are only the inventories they have sitting on the shelves right now. So Bed Bath & Beyond is in trouble. They have a what we would call a liquidity issue. They don't have enough money on hand to pay their current liabilities as they are coming due. That's not a good scenario when your cash and cash equivalents aren't really able to cover what they need to. So if we get into the latest quarterly filing from Bed Bath & Beyond, we can see they actually have a going concern note in the notes on their quarterly filing. And we can see it says, on or around January 13th, events of default were triggered under the company's credit facilities, which means they basically have agreements with their banks that are providing credit lines that they have to meet certain ratios, current ratios, different things like that. And they started to trigger some issues because their numbers and their financials have gotten so bad. And so now they're basically in default. They're not in agreement with their loan covenants anymore. Company's failure to prepay and over advance and satisfy a financial covenant, among other things, have caused and triggered them to be under default. Furthermore, the company does not have resources to pay the amounts under the credit facilities. That is not good. And you can see down here, we have a going concern. We're not even sure if we can last an entire year. There's some uncertainty there. So Bed Bath & Beyond is hurting. Well, what's this got to do with Treasury stock? Let me show you. If we look at the equity part of the balance sheet for Bed Bath & Beyond, where we would have Treasury stock, we can see it right here. Treasury stock is going to show up as a negative amount because it's literally Bed Bath & Beyond buying back their own stock to the tune of $11.7 billion. Now think about that for a second. We're talking about a company who has basically, $439 million in cash on the brink of bankruptcy, but they've bought back $11.6 billion in their own stock over the past 10 years. It's wild to think about. Here's a note from the annual report. During 2021, we bought back 28.3 million shares of our stock at a total cost of $600 million almost. So even as the business is going down the proverbial drain, they're out there buying back their own stock. Probably not the most brilliant business strategy there, but what do I know? I'm just teaching accounting. So good investment. Again, from the annual report between December 2004 and April 2021, the company, Bed Bath & Beyond Board of Directors authorized the repurchase of $13 billion of its shares of common stock. Company has repurchased approximately $11.6 billion of its common stock through share repurchase programs. Goodness gracious, I bet they would like to have that money back right now. So our goals today, aside from making fun of Bed Bath & Beyond, describe Treasury Stock, understand what it is, and then I also want to show you the accounting for Treasury Stock. So right back there, the shareholders' equity part of the balance sheet. Again, we can see the Treasury Stock right there and the amount that they've paid for it. Treasury Stock, simply the stock of a company that they've bought back. That represents shares of Bed Bath & Beyond that Bed Bath & Beyond have bought back from investors. Literally, the company is buying back itself. That's why it shows up as a negative under the equity section. When we issue common stock, it adds to equity. When we buy common stock back, it takes away from equity. You can say, well, hold on a second, Martin. Treasury stock, it almost seems like it'd be on the asset side of a balance sheet. And I get that, but a company can't own itself. You see what I'm saying? Assets are things that we own and that we kind of use them in the course of business. Well, we can't really own ourselves, right? And so we kind of throw that down there as a reduction of equity when we have Treasury stock. So why buy back? Why did Bed Bath & Beyond do something that now in hindsight seems like a terrible move? Well, there's all kinds of reasons why a company might want to buy back their own stock. First of all, investors typically love it when a company has a share buyback program because it kind of puts an artificial floor on the stock price. What I mean by that is if the company is stepping in and saying, we're going to buy back the stock when it gets to a certain level, well, it's not going to drop below that because the company will step in and start buying shares and it makes the price go back up a little bit. So it's kind of like a support for the stock price. It also sends a signal to investors and it makes them think the stock is a buy. Because if you think about it, who knows more about the company than the company? And so if the company's out there buying back their own shares, it makes investors think, well, hey, they know better than anybody else. If they think it's a buy at $20 a share, maybe I should buy some too. So a lot of times a buyback will make the investors happy. It will kind of create demand for the stock and make people feel good that there's going to be maybe a floor on that stock price. It could also be strategic reasons. Maybe they're trying to acquire or use it in acquiring other companies and buy back our own stock. And then if we want to go out and buy a competitor, we can use our stock as payment in lieu of cash. It can also help us avoid a hostile takeover. Maybe if there is a shareholder amassing a lot of stock and they're starting to make some noise and trying to get on the board and threatening to kind of get enough of the company to take it over, that might keep it from happening if we can buy back enough of our stock to kind of bar them from doing so. Compensation reasons, we can also use our treasury stock to compensate employees and reissue that stock as compensation to our employees. So all kinds of reasons why a company wants to buy back stock. Now, I mentioned at the beginning, this is a pretty common thing. We see it all the time in the Wall Street Journal. We see it on CNBC. But the jury is out. And there are all kinds of academic papers written on whether or not this really provides value in the long term for a shareholder. And I want to really emphasize that here. I'm going to show you some articles. This is literally from the last month from the Wall Street Journal, February 17th. Stock buybacks aren't bad, but they aren't good either. Talk about riding the fence right there. And so we got one kind of lukewarm take. Same month from the Wall Street Journal. Corporate stock buybacks help keep market afloat. Seems like a pretty pro vote for share buybacks. Wall Street Journal making the case here that if it wasn't for stock buybacks, maybe the market would be looking really bad. But again, companies are kind of swooping in there, buying back their own stock and maintaining price levels. Again, from February, Newsweek, stock buybacks help no one in the long term. An opinion piece right there talking about how stock buybacks are bad. Wall Street Journal back in January, quoting the Biden administration planning to raise taxes on companies who were instigating share buybacks. And they put a 1% tax in. The Biden administration was talking about making it a 4% tax, quadrupling the 1% tax that they put in, which is actually a new tax. So all kinds of opinions about share buybacks. Politically, should companies focus more on lowering prices, lowering profits instead of buying back their own shares with all these excess dollars they've accumulated? Investors tend to like them. And then we have the head honcho investor, Warren Buffett. He says if you don't like stock buybacks, or if you're a critic of a stock buyback, you're an economic moron. You're illiterate. You fool. How could you not like it? And so again, as I mentioned, academic papers have been written examining this issue and whether or not they provide value for shareholders. They've not come to a conclusion yet, and they argue about it in the media. And so our goal here isn't really to decide whether or not they're good or bad. We're accountants. We don't make value judgments like that. We just follow the numbers and try to account for it. So one last word on Bed Bath & Beyond. When a company buys back their own stock, it's no different than you or I. We want to buy low and sell high. Bed Bath & Beyond instigated their purchase program back in 2004. And you can kind of see they bought all through this period. And then they did not do a good job of buying low and selling high. They did the opposite. They bought high, and then the stock cratered all the way down to almost zero as they filed bankruptcy. Here's somebody that maybe did it right, though. Apple. Apple in 2012 announced their first stock buyback program and dividend program. And their plan at the time was authorizing $10 billion for share repurchase back in 2012, beginning in 2013. So how did that investment turn out? Well, okay, Apple bought stock back here in 2012, and woo, look at that roller coaster ride, all the way up to the top of the mountain. So Apple, a little bit more successful in buying back their own stock. And again, literally, you can look at a lot of examples where a company bought back their own stock. General Electric, for one, back in the early 2000s comes to mind, bought their stock back at a high price, and the stock tanked. Airline companies have come under fire for buying back their own stock and later filing for bankruptcy, needing a bailout. So you can find all kinds of examples where it doesn't work, and then you can find all kinds of examples where the company actually buys back their stock and the stock goes through the roof, like with Apple. Just one of those things. There's a case on both sides. How about the case for accounting for Treasury stock? 2 general rules that I'm going to share with you. First of all, corporations cannot recognize any gains or losses when reacquiring their own stock. All right, so when they reacquire it, when they reissue it, we cannot recognize gains and losses and put them on the income statement. If we could do that, it would be so easy to game the income statement. If we were short on revenue or gains from what the analysts were expecting, we could just simply trade our stock, boost it up, right? And so, not allowed. We cannot ever count gains and losses when we're dealing with our treasury stock, when we reissue it, when we buy it. The second point there, treasury stock transactions can reduce retained earnings, but kind of along the same lines as rule number 1 there, they can never increase retained earnings. All right? We will never, ever have a credit to retained earnings, increasing retained earnings as a part of an entry dealing with treasury stock. We cannot increase retained earnings. So how do we do it? Accounting for treasury stock. And this gave you a little simple example here. When we issue stock to begin with, we've talked about this before. If we issue it for cash, we'd have a debit to cash, and then we'd split up that credit between common stock for the par value and additional paid-in capital in excess of par. Like I showed you at the beginning, when we issue stock, equity goes up, doesn't it? Well, when we buy it back, equity's going to go down. The transaction's going to have the opposite effect. It's removing equity. Again, that's why it's showing up as a negative amount under the equity part of the balance sheet. Now we have 2 different methodologies for accounting for treasury stock. We got a cost method and we got a par value method. Cost method is the most common by far. Most all the financial statements that you look at are going to account for it using the cost method. That's what I'm going to focus on here. In fact, if you think back to that Bed Bath & Beyond statement I showed you, it said treasury stock at cost. They're using the cost method. All right. Basically, what that means is they're accounting for it using whatever they paid to buy back the treasury stock. There's also a par value method, GAAP approved. We can use it if we want to. And it's going to focus on the par value of the stock we're buying back as opposed to what we paid. All right. So here we go. The basics. Cost method. Company assumes it will reissue the stock at some point and not retire it, although they can retire it if they decide to, meaning they'll just take it out of circulation completely. Debit a treasury stock account for the cost paid to buy back the shares. That's first part of the entry. Whatever we paid to buy back the total cash amount, that's going to be a debit to the treasury stock account. And that treasury stock account is a contra shareholders equity account. Like we showed you before, it's going to be a negative under equity. Contra, opposite. So let's do an example here. We got Bingo Corporation. They issued 6,000 shares of $10 par common stock for $12 a share on January 1, 2022. Then they bought back 1,000 of them, $13 a share on 1/1/23. So, first step here. Bingo Corp issued 6,000 shares of $10 par common stock for $12 a share on 1/1/22. Take a second. Think about that. See if you can come up with the journal entry. I'll let you pause the video and see if you can write out the entry for that. I'll give you a minute to do that. All right, hopefully you've had an opportunity to go ahead and make that journal entry. The first part, the cash total amount that was received when we sold the stock. And again, we're splitting up the credit between the par value of the stock and the additional paid in capital. How about that second part, the part where we actually went back and reacquired 1,000 shares of common stock? Well, we said we're going to have a debit to the treasury stock account for the total amount paid and a credit to the cash account. $13 times 1,000. Bring that back up here. There we go. Treasury stock, 13. And our credit to cash, 13,000. So now we have treasury stock. We've pulled that stock out of circulation. We've taken it out of the marketplace, and we're accounting for it on the equity part of the balance sheet. We have $13,000 in treasury stock. That's the easy part. Simple. What happens when we actually reissue it? You don't want to sit on it forever. At some point, we may reissue it. When we reissue treasury stock, we reduce or credit the treasury stock account for the cost of what is being reissued. Then we take the difference between the cash we get from reissuing it and the cost, and we basically make an adjustment to shareholders' equity. So I'm going to show you how that works real quick. If we reissue for more than we paid, all right, so let's say we paid $35 per share and we reissue it for $40. We reissue it for more than we paid. That difference, that $5 difference, that increase is going to be an increase in an account called additional paid in capital on treasury stock. If it's the opposite, if we reissue it at a loss, if we paid $35 per share to reacquire it and then we flip it for $5 loss, we're going to reduce additional paid in capital on treasury stock. And if there's not enough in that additional paid in capital to absorb that loss, then we run it through retained earnings as a debit to retained earnings. Again, never increasing retained earnings, but we can decrease it. So let's put a few numbers to it here. Bingo Corp reissues 600 shares of treasury stock at $15 a share. Remember, we just reacquired 1,000 shares at 13. Now we're flipping them at 15. So we have a little gain here. We're going to be adding to the additional paid in capital on treasury stock account. 600 shares we're buying back at 15 a share. Well, let's take a look. Our cash debit, again, we're reissuing the stock, so we're going to get money. 600 times $15 that we sold it for. We're getting $9,000. Treasury stock, 600 shares are now gone. We don't have them anymore. We paid 13, so 600 times 13 would be 7,800. Now, we're plugging additional paid-in capital on treasury stock, 1,200. $2 difference, what we bought it for, what it sold for, times 600 shares. 600 times $2 difference is 1,200. Again, got to emphasize, we do not credit retained earnings here because we can never add to retained earnings or add gains in income from a treasury stock transaction. So we just kind of throw it on the equity part of the balance sheet. What happens if we reissue it at a loss? Let's assume that Bingo Corp reissued 200 shares of a treasury stock at $8 a share on 5/30/24. Remember, we bought it for 13. We have a $5 loss per share going on here. So there we go. There's our circumstances. Our entry, cash debit, 200 times $8 a share. We debit cash for what we got. Treasury stock going away, 200 times $13 a share, which is what we paid for it, 2,600. And you'll notice I have a debit to additional paid-in capital on treasury stock. $5 difference, what I paid for it, what I got for it, times 200. Now, that additional paid-in capital treasury stock account. You'll recall when we sold the treasury stock the first round, we had 1,200 going into that account. I can't take that account lower than zero, okay? So here I have 1,000. I can absorb that loss. If I could not absorb that loss with my additional paid-in capital balance, I would have had to debit retained earnings for the difference. I would exhaust additional paid-in capital on treasury stock, and if there's still loss left over, I would debit retained earnings. But I had enough to absorb it. I have a $200 balance left in that additional paid-in capital treasury stock account. So, reissuing one more. Let's say Bingo Corp reissues 100 shares of treasury stock at $10 a share. And remember, we paid 13. So again, I'm reissuing at a $3 loss right here. The facts up there. We'll throw the journal entry up. Cash debit, 100 shares times 10 per share is what we got, $1,000. Treasury stock credit, getting rid of the treasury stock, we had paid 13 times 100 shares gives me 1,300. Now remember, I had 200 left in that additional paid-in capital to absorb any loss. I'm exhausting it. I'm down to zero now, but I still haven't balanced the entry. All right, so that retained earnings is now coming into play. I exhausted my additional paid-in capital on treasury stock, and now I've got to run the remaining loss as a debit through retained earnings to make the entry balance. So it's kind of a plug. Once I exhaust that APIC, additional paid-in capital, then I got to plug retained earnings as a debit. Never ever credit retained earnings, all right? Because we can't add to it, we can only take away. I'm out of additional paid-in capital, which is fine because I've sold back all the treasury stock. Now, that is our cost method. As I mentioned, the par value method is also an option, and we're not going to cover that a whole lot. You're welcome to read the one page or so in your book, and not a lot of companies use that methodology. In fact, I'm going to post a solution in Canvas for the one homework problem that uses it, just to kind of show you how they come up with the numbers and what it looks like. But that's not my big concern. My big concern is that you know how to do the cost method, because that's what people are using out there. Now, final thought. In our example, we basically sold back all the treasury stock that we acquired. In some instances, a company may decide to go ahead and retire the treasury stock and remove it completely. In those instances, it's really very similar to an asset disposal. You have to get rid of everything associated with the stock. So you'd have a debit to common stock, you'd have a debit to additional paid-in capital on common stock, and then of course you'd have that credit to treasury stock. So you may run into an example like that in your homework. And again, you may want to refer back to your book to help you out with that. But that's the idea, treasury stock. The game we're playing, we're buying back our own company. All right, and maybe one day you can go on and get a doctorate in accounting or a doctorate in finance and write a great research dissertation about the pros or cons of stock buybacks. And if you do that, share it with me. I'd love to read it. In the meantime, that wraps up the entire chapter, and we will move ahead into chapter 16 and talk about a few issues like dividends and calculating earnings per share. So it'll be some interesting calculations and discussions to be had there. Until then, that's it for now. Take care, everybody.